To run a profitable manufacturing floor, you have to know exactly how much it costs to produce a single unit of inventory. If you don't know the accurate cost, you cannot set a competitive price. Some costs are simple to track. Direct materials, the actual physical components of a product, are purely variable costs. If you build one wooden chair, you know exactly how much wood went into it. Direct labor is similarly straightforward. It is the human effort tied directly to production, easily quantified by the exact time a worker spends assembling that unit. Then we hit the third pillar of manufacturing costs, overhead. These are the expenses necessary to keep the factory running, but completely impractical to trace to any single finished product. Overhead contains a variable component, which fluctuates with production levels. This includes indirect materials, like the welding compound used on an assembly line, and indirect labor, like the wages for the janitorial staff. Overhead also contains a fixed component, which remains steady regardless of output. This covers items like factory real estate taxes, insurance policies, and straight-line depreciation on heavy machinery. Here lies the core accounting friction. Fixed overhead costs do not change whether you produce 10 chairs or 10,000. Yet, to calculate the true cost of a single chair, a fraction of those fixed costs must be absorbed into it. To solve this, accountants use a framework called normal costing. Instead of waiting until the end of the year to tally up every bill, this system utilizes predetermined rates to allocate those untraceable costs to products as they are being made. Normal costing intentionally forces fixed costs into a per-unit format. Because it relies on estimates, this system guarantees that the applied costs will differ from the actual bills at the end of the period, creating mathematical variances that reveal key operational data. Forcing non-variable costs into a unit cost is a structural necessity. It provides a stabilized, predictable cost per unit, which is required for accurate financial reporting and pricing strategies. The normal costing cycle begins before the fiscal year starts. Management first estimates all budgeted overhead for the upcoming 12 months. These estimated costs cannot be lumped into a single category. They must be separated into homogeneous cost pools, based precisely on how the costs behave. Looking at this manufacturer's budget for the upcoming year, we can see this behavioral separation in practice. In the left column, indirect materials, labor, and utilities are grouped together. Because these expenses scale with the level of factory output, they form a variable overhead pool, totaling $281,000. On the right side, real estate taxes, insurance, and straight-line depreciation form an entirely different pool. These will remain flat regardless of output, yielding a fixed overhead total of $375,000. Variable and fixed costs require separate pools because they react to the pace of production differently. Isolating costs based on their underlying behavioral traits is the required first step before any mathematical allocation can begin. Once costs are pooled, they need a mechanism to drive them into the actual products. This is called an allocation base, a specific operational metric, like labor hours or machine hours. The strict rule for selecting an allocation base is that it must capture a cause and effect relationship. The driver chosen must be the operational reason the costs in that pool are being incurred. In a labor-intensive industry, direct labor hours are an appropriate driver. But if the factory is capital-intensive, machine hours capture that cause and effect much more accurately. A common accounting trap is applying a single plant-wide rate, using one generic driver for the entire factory to simplify the bookkeeping. We can observe how this distorts financial reality by analyzing this company's departmental allocation records. The top calculation shows a plant-wide approach. The total $100,000 overhead budget is divided by 20,000 direct labor hours, yielding a flat rate of $5 per hour. But the operational breakdown below reveals a different story. Department A heavily utilizes human labor, accounting for 15,000 labor hours. Department B is highly automated, using mostly machine hours. The correct approach requires departmental rates. Department A retains labor hours as its allocation base, resulting in a rate of $4 per labor hour. Department B switches to machine hours to reflect automation, resulting in a customized rate of $2.50 per machine hour. If the company had forced that original $5 flat labor rate onto Department B, the highly automated products would absorb almost no overhead, artificially lowering their calculated costs. Failing to match specific allocation bases to distinct departmental realities mathematically guarantees mispriced products and misinformed management decisions. To finalize the predetermined rate, the budgeted cost pool must be divided by an estimated capacity denominator. Management typically evaluates 3 levels of capacity to set this denominator: normal, theoretical, and practical. Practical capacity is the required standard. It represents the maximum level of output a factory can produce efficiently while allowing for realistic downtime like maintenance. Once the rate is established based on practical capacity, the budget phase ends. During the year, accountants apply this rate to the work-in-process inventory based on actual operations. This table outlines the application phase in action based on the actual driver usage tracked over the year. Notice the predetermined rates calculated before the year began: $4 per unit for variable overhead and $2.50 per machine hour for fixed overhead. At the bottom, these estimated rates are multiplied by the actual output, 95,000 units and 300,000 machine hours, to calculate the final applied amounts. By applying fixed costs based on a fluctuating driver like machine hours, the accounting ledger will show a variance if production surges or plummets. This creates a denominator-level variance. It is a deliberate feature of the system that alerts management to unutilized capacity in real time. When the fiscal year closes, the total overhead applied to inventory must be compared against the actual invoices the company received. Because we used budgeted estimates applied to actual activity, the applied amount and the actual incurred amount will never perfectly match. If the applied total is higher than the actual bills, you have over-applied overhead. Product costs were mathematically overstated because factory activity was higher than expected, or bills came in lower. If the applied total is lower than the actual bills, you have under-applied overhead. Product costs were understated, either because expenses spiked or factory output dropped unexpectedly. These variances are the expected mathematical drift inherent to normal costing. Before issuing final financial statements, the ledger must be formally cleared. The method used to clear the variance depends entirely on the threshold of materiality. Let's examine a scenario where the variance is statistically insignificant. Here, the net variance is just $3,000 under-applied. Because this amount is immaterial, accounting rules allow it to be written off entirely by increasing cost of goods sold. Contrast this with a scenario where the variance is massive and requires proportional adjustment. In this breakdown, the company has an $85,000 over-applied variance, which is far too significant to assign to a single account. Accuracy demands proration. The $85,000 correction is spread proportionally across work in process, finished goods, and cost of goods sold based on their existing balances. Normal costing operates as a structured engine that smooths volatile factory expenses over the year. It provides management with a reliable cost baseline to make real-time decisions before mathematically enforcing reality at year-end.